Hello, and welcome to the Encyclopedia of Commercial Real Estate Advice channel, where we give insider tips on over 500 real estate topics from the book, The Encyclopedia of Commercial Real Estate Advice by Terry Painter. So, Terry, as a real estate investor, I'm dying to know why you call this the Non Recourse Loan Club. You make it sound kind of exclusive.
I know. I do that because it almost appears that way. It almost seems like it's a secret or something. And a lot of my very wealthy clients only take out non-recourse loans. And it almost seems like a club, but it really is not. There's no club.
Okay, so I've heard about them, but I have to admit I don't really know what a non-recourse loan is. So can you break it down for me?
Well, let's start off by talking about what is a recourse loan. And 90% of all consumer loans and real estate loans in America, over 90%, are recourse loans. And banks especially love their recourse. Why? Because it gives them the ability to go after all of your personal assets should you default on the loan, because they have gotten you to sign a personal guarantee. And sometimes if you have multiple investors, they're going to get everybody to sign that guarantee. So they could go after everybody's personal assets. They can only do that if they sell the property for after you default for less than what you owe on it. And they're going to tack on attorney fees and court costs. And I assure you that you're going to end up owing them something more than what you currently owe them when they sell the property. And what they get is a deficiency judgment by the court, because which the personal guarantee allows them to do. And with that, they can attach it to your bank accounts, the title to your home, your boats, your RVs, even your child's education savings account.
Right. This is the part about sort of having skin in the game, right? So if you're saying that a non-recourse loan can protect us from all of that or protect me from
Yeah,
all
it's
of that.
actually it exactly does exactly that. It's amazingly simple. Why? Because the loan is not made to the borrower personally. It's made to a third party single asset property ownership entity, like a LLC, an LP, a corporation. It's not made to you. So if you default on the loan, all they
Yeah, can
can
you give
do
me an
is,
example of this?
yeah, okay,
Sorry.
all they can do is go after the property. Yeah.
Okay.
Well, yeah, let me give you an example. Okay, in 2005, I was speaking at a real estate seminar, and this guy comes up to me after my spiel, and he says, "Hey, you don't know this yet, but you're going to be financing this mixed-use building for me in downtown Tulsa, Oklahoma." And I said, "Really? Tell me more." Well, I actually went out before I left town. I actually went out and saw the property with him. He had so much enthusiasm, and I just loved the project. And it was a beautiful Art Deco 1940s building with the retail spaces on the floor were, except for a thrift shop, were empty. And then the apartments were kind of run down. There were 36 on the upper level. And it's the opportunity to buy it for about $2.4 million. There's a lot of real estate, even in those days, for what he was getting. He was going to be putting over 700,000 into renovating it. So I arranged bridge financing for him. It didn't really take that long. He didn't have he didn't have the experience, but he had a really good contractor he was teaming up with. So what happened though is the property, I was really impressed with him because after 18 months, he was ready. I did the loan for 2 years, but after 18 months, he was ready to pay our loan off. And because he had the place pretty much fully leased. And then the Great Recession hit. He
Oof.
did Before that, though, he took out a loan at his bank for the perm loan. He paid our loan off. So what happened is that with the Great Recession is that downtown Tulsa got hit really hard. And the real estate office downstairs moved out, and another office moved out. The thrift store still stayed there. And his tenants, a lot of them stopped paying rent or paid late. So he couldn't make, so even though, but he still had enough sources of income. He was still making all of his loan payments to the bank on time on this building. But what happened is that the bank got scared, did an appraisal on the building. They found out that it dropped in value. And then he was no longer meeting their minimum debt service coverage ratio, which was a 1.3. He was less than a 1. So they called his loan due and payable. He was shocked when he got the letter. He really couldn't do anything in time. He just didn't have enough time. And so what happened is that when the bank got the deficiency judgment after he went through foreclosure, he literally, they couldn't attach it to his home because he had homesteaded the home and he protected it, not knowing that's really what he was doing. But then the bank did go after his 2 rental homes and his antique car collection. He said to me, Terry, how do
No.
they know about my antique cars? I've been collecting these all my life. I said, because you have them on your personal financial statement.
Mm,
So there you go. So he went, I really felt, it really broke my heart to see him go through this because he was a really good person. And
wow. So
if he had had a non-recourse loan,
non-recourse, it would have been different?
yes, all he would have to do is just turn the keys to the building back over to the bank and walk away. It would be painful,
Yeah,
absolutely, because he put his sweat equity plus a lot of money into that building. But it would be better than losing the building and a lot of his other assets.
right, right. So Terry, what are the 4 benefits? What are the 4 benefits of a non-recourse loan?
The very first one, which I've already talked about, is asset protection. That's what asset protection is. It's not losing your home, your car, your other toys if you default on the loan. The lender
Right.
just can't do that. So we've already gone through asset protection. The second one, which is the one that I write about quite a bit in my book, it's absolutely imperative that if you are raising investors,
Mhm.
that you take out non-recourse financing. And the only way to really get ahead quicker, faster in building a real estate portfolio is to raise investors. Because if you think about it, if you have a job and let's say you have some rental properties and you're saving money from your income, think about how long it's going to take you to buy your next investment property unless you sell it. If you want to keep your properties and let them grow and appreciate. So with non-recourse financing, because you don't have to ask any of your investors who join with you the bank cannot ask them to guarantee the loan. They're not going to be risking their personal assets, so you can raise investors much easier. Any investor that's going to be putting 20% or more of the equity into the project, any lender will require them to sign a personal guarantee.
Okay,
If it's,
right. So it makes everybody feel more secure.
yes, so
Mhm.
that's really a big one. The third one is there's a really important tax consequence that you could avoid if you take out a non-recourse loan. And I've known lots of people who have been hit with this. But what happens with a lot of commercial loans, or even for that matter, your home loan, if you default on it, the bank does not go after your assets. In other words, if you declare bankruptcy and you're able to get by with not ever paying this amount back, let's say, what happens is that the government looks at it as canceled debt. And canceled debt, the IRS actually can tax you on that. And they could apply capital gains rate taxes to you on that. So that's not going to be fun because that could stay with you for many, many years. Now, with a non-recourse loan, they just don't look at it that way. They don't look at it as canceled debt. They look at it that, first of all, this loan was not made to you, it was made to the LLC. And as far as they're concerned, the LLC has simply given the property back to the lender for what was owed on it. That's how they look at it. So there's no canceled debt. There's no tax consequences.
Interesting. That's a
Isn't
big
that great?
benefit.
Yes. And the fourth benefit is that not very few people know this, but you could actually invest your IRA in real estate if you could find a non-recourse loan to finance the property. And this is called, you have to put together a self-directed IRA to do this. And I don't have time to go into that on this
Okay.
video, but you could certainly look it up on the internet and find out more about it. But these are not high leverage loans. They really are average about 55%, maybe 60 at the most, but they have to be non-recourse because the lender cannot go after, if it was a recourse loan, they could go after,
Mhm.
your other assets, make you insolvent financially. The government doesn't want to see that. So you're really protected in that case. So you could actually, what happens if you invest your IRA in a commercial property, let's say, you're going to be getting 5 sources of income instead of just 2 with stocks. Stocks have interest and dividends, but commercial property, for that matter, any investment property has income from operations, income from rental increases, income from appreciation, depreciation, and also if you want to take the equity out and reinvest it, that's a 5th source of income. And so your IRA is going to grow a lot faster in real estate. That's another secret, hidden secret. that
Wow.
the government certainly and doesn't talk about.
Hmm.
So
Okay. Well, so we're talking about lenders and the government, who's the lender. Who makes these non-recourse loans though? Who offers them?
yeah, well, you certainly can't go to your local bank. As I mentioned, there, if you asked them for a non-recourse loan, they would like look at you like you're a little bit nuts. It's not to say that there's a few that do make some of the larger banks, if you're putting like 75% down, a very large amount down, they could probably make a non-recourse loan for you because the chances of you defaulting are just about zilch. So, but otherwise, for multifamily, we have three lenders that make these loans, and that's Fannie Mae, Freddie Mac, and FHA HUD. And they all have great terms. HUD loan especially, you can't really beat. It's got a 35-year fixed rate, fully amortizing loan. And then you have CMBS, which stands for Commercial Mortgage-Backed Security. And those loans are always non-recourse. We have life companies, which are, life insurance companies actually invest money in real estate loans, and those loans are always non-recourse. And we also have what we call private debt fund lenders. And a lot of these are bridge lenders. So if you're going to do a rehab project that might be too large for the bank or too risky, sometimes the private debt lenders will be able to take that debt on, and uh, many of those are non-recourse.
Okay. All right. So now I need to know, what does it take to qualify, right? That's next. What is
Yeah,
qualifying for a non-recourse loan more challenging, or?
well, it actually is because first of all, these loans start at $1 million and go up. It's just that, and they also have higher loan expenses. So I would say that if you could even do a loan at 1.5 million and up, it would be even better. But certainly $1 million enough should work. Uh, so majority of real estate investment property loans are under $1 million. Uh, Another qualification is that you have to find a great property in a good location, or if it's needs some work, like let's say the rents are under market, you need to do some repositioning, maybe increase the rents by doing some improvements. There is non-recourse lending available for doing that. Uh, you have to have the third one is having strong property financials. So if the property was just fixed and flipped and it doesn't have any history yet, it's going to be more difficult to get a non-recourse loan. Um,
Okay.
The fourth qualification is having good rent collections. These loans actually do check to make sure that the tenants have paid the rent and are paying timely. And having gone through COVID, where so many renters defaulted or just paid late, that's a real concern for all lenders, but for non-recourse lenders, it's always been that way. Uh, the sixth one is having strong management. It's not to say that you can't manage the property yourself, but if you don't have experience, managing a property the size and scope of what you're going to be purchasing, let's say, then you're going to need to get professional management. And the last one is you're going to need to have great tenants with great leases. In other words, if all the leases are expiring or they're on month to months, that might be this could be a problem for a non-recourse lender. And also, you want to have good quality tenants, like if it was a shopping mall or an office building. You want national tenants that have credit rating or better. And you certainly want to, once again, you want to have proof that the tenants are paying the rent. So that's pretty much it.
So my question is, if the story that you told us about your client in Tulsa, would he have been able to qualify for a non-recourse loan given the building that he was looking to finance?
That's a really good question. Okay. Well, here's the thing is that in 2005, Tulsa was up and coming, but it wasn't, it was showing possibilities of the downtown coming back. It was doing better and better. So chances are, chances are there would be some non-recourse financing, especially for him, especially from a private debt fund lender. They would, and that's basically, just that. So just out of the gate, he would have qualified, he qualified for my bridge loan, which was recourse, and he had no problem with that. And then when it was time to do the permanent loan at that time, we could have financed him with a CMBS loan, which would have been non-recourse. And because the property was doing well, and the markets studies, the market supported Tulsa for that size of a project, it should have been fine for non-recourse financing.
So if it were happening today, he might have started with the bridge loan, and then you would have worked him into a non-recourse loan. Yeah,
exactly. A lot of my investors start out with bridge financing that is either recourse or non-recourse, but they definitely have to have a non-recourse perm loan if they're renovating a property.
All right. Well, Terry, thank you so much. I've learned a lot, and it's so nice to learn about this non-recourse loan, and to know that even if you don't start out in one, you can end up in one for the long term.
Absolutely. It's something to aim for, and it's really important to just have it in your radar to join the non-recourse loan club. And for those of you who would like to learn a lot more about commercial financing and a bunch of other topics on commercial real estate, my book, The Encyclopedia of Commercial Real Estate, goes through a lot of topics, but it also has 2 great chapters on commercial financing. And thank you for watching this video. I'll see you on the next one.